Welcome back. This is our third video in your Cornerstones textbook chapter 1. We're going to cover more financial statements, and we're going to start with the income statement, which is showing us a period of time, a month, a year, maybe a quarter, and it's going to show us how the company made net income, or what we sometimes call profit. In accounting world, we always usually just call it income or net income, but it's like talking about profit. And you know in your brain that profit is really taking all that you made and subtracting everything that you had to spend to get it, and it's what's left over, right? Well, everything you make in sales is called your revenues, and that comes from either selling a product or a service. You may actually make some revenue through interest income too, if your company invests some of its cash and makes some interest on it. Now, all of your expenses are going to fall into some of these categories. Cost of goods sold deals with the direct cost of selling a product. So if you are Walmart, your cost of goods sold is going to be the cost of all of the toothpaste, the wholesale price you pay for all the toothpaste and all the bananas and all of the t-shirts and things like that. Not every company has a cost of goods sold. Some service companies do not. Selling general and administrative costs, every company has. This is just the cost of doing their business. It's the cost of keeping the lights on. It's the cost of salaries for their secretaries and for their maintenance people, for their sales team. It could be the cost of advertising. Some companies have costs for research and development expenses, especially pharmaceutical companies and companies that really rely on a lot of research to create their products. We could have other expenses, maybe even like interest expense if they have debt that they owe interest on. And then most companies have an income taxes expense. If I take all of the revenues and I subtract all of the expenses, I come up with my net income. Now, there's two ways to think about the income statement. There's what we call the single-step income statement. We put the heading info. Remember, that's just company name, name of the statement, and the time period that's covering. In this case, you would say for the month ended January 31st, or the year ended December 31st, so that we know how many months or what time period it covers. You would then list all of the company's revenues, all of them, and total them. Then you would list all the company's expenses and total them. And you'd subtract the expenses from the revenue to get you net income. So let's do that. This is the simplest form of an income statement. If we're going to go back to Hightower Inc., Cornerstone 1-3, if this is the information that they have on their sales and expenses, could you prepare an income statement? Well, remember, we have to first list all of the revenues. So what are the revenues? Yes, they have sales revenue here of $50,600. Is there anything else? Yes, there is interest income, and that is considered a revenue. So we would put both of those in the revenues category. Now remember, you're also supposed to list all the company's expenses. So what are the expenses on here? Well, I've got cost of goods sold. That's an expense. I've got salaries expense. I've got insurance expense. Got income taxes expense, I got interest expense, I have depreciation expense. Remember, I don't write a check for depreciation, but I do have to note that there's a loss of value in all of my assets, if they are long-term assets, and I have a rent expense. Lots of expenses, not as many revenues. Let's stick them in the income statement. Sales revenue, $50,600. I got my interest income of $1,200. I got cost of goods sold here. I work them all the way down. Notice I'm going to total my revenues, $57,800. I'm going to total my expenses, $46,940. If I take this number and I subtract this number, I get $4,860. That's my net income, or the profit for Hightower Inc. Now, we could have a slightly more complex income statement. We call it the multiple step income statement. Once again, we always prepare the header. Then I list the company's revenues and I total them. Then instead of just putting a long list of all the company's expenses, I next list the cost of goods sold, if there is some for that company. And then I take revenues minus COGS and I get gross margin. That's revenues minus cost of goods sold. Then I list all of the operating expenses, and if I subtract all of the operating expenses from what I had calculated as the gross margin, minus all of these, gross margin minus all of the operating expenses, I get income from operations. Actually, let's just make sure we're clear there. Gross margin minus all of the operating expenses. Then I list all of the non-operating expenses, things perhaps like interest expense or something like that. And if I take my income from operations and I subtract all non-operating expenses, I get pre-tax income. And finally, I'll list my income tax expense, and once I subtract that, I calculate net income. Now let's plug that all in. Let's just look at what a multiple step income statement looks like. Notice everything is still in the same category. I've got my sales revenue of $50,600. Then I immediately subtract cost of goods sold. And I put it in those parentheses because I'm going to calculate the gross margin, and that is sales revenue minus cost of goods sold. So my gross margin is $19,300. Then my operating expenses, what were those? Those were salaries, rent, depreciation, and insurance. It didn't include interest expense. It didn't include income tax expense. We wait for that. So I put all these operating expenses in. I total them. They equal $13,100. In order to get my income from operations, I take my gross margin, $19,300. I subtract $13,100, and I get $6,200. Now, I sometimes will put my interest income way up here with my revenues. I don't always. Sometimes what I do is I have this space called other income and expense. And I'll put my interest income in there. That's positive, right? That adds to my bottom line. And then I have interest expense, which is going to be in the parentheses because that's an expense that subtracts from my bottom line. Together, my other income and expense, $1,200 minus $540 is $660. So if I take income from operations of $6,200 minus the $660 of interest expense, I come up with pre-tax income of $6,860. I had income tax expense of $2,000 noted as a subtraction by the parentheses, so I get my bottom line, net income $4,860. Notice you get the same bottom line. How do I use the income statement? Well, notice it's telling me based on revenues and expenses what my net income is. Well, that's a thing called profitability. My net income is a measure of my profit, right? I can measure profitability by using my income statement. I can calculate something called the net profit margin or the net income margin. Notice sometimes in accounting we have multiple names for the same thing. You'll just have to start paying attention to those. Your book calls it net profit margin, and that takes the net income, the bottom line of your income statement, and it divides it by the sales revenue. What is that basically saying? Well, you're going to get an answer that's going to be somewhere between 0 and 1, which means you can convert it into a percent, right? If you get 0.81, that's the same as saying 81%, which would be an awfully nice net profit margin. You won't probably ever see that. What it's telling us is for every dollar of sales revenue, after I subtract all of the expenses, what is left of that dollar in my hand as net income? Well, if you're a business, you want to hang on to as much of every sales dollar as you can. You don't want it to slip through your fingers in expenses, right? So you want to keep this net profit margin as high as possible. All right, third financial statement is the retained earnings statement. Sometimes it's also known as the statement of stockholders' equity. Now remember, what is capital? What did we say capital was back on the balance sheet? If you said capital is your liabilities plus your stockholders' equity, that's everything on the right side of the accounting equation, you are correct. Well, your retained earnings is trying to deal with just the stockholders' equity piece from the balance sheet. Remember, on the balance sheet, the stockholders' equity dealt with common stock purchases and retained earnings. Retained earnings, by the way, Everything a company retains every year is its total net income from the income statement. Remember, that comes from the income statement. And you subtract all the dividends, which, remember, were the distributions to the stockholders. Well, obviously the company doesn't retain it if it distributes it to the stockholders, so retained earnings is always going to equal net income minus dividends. Why do we use this retained earnings statement? Well, one of the main reasons, make sure that we've got the right dividend flow, that we're not sending too many dollars out to our stockholders every year and not retaining enough to grow the company. So how do we make a retained earnings statement? Once again, you always have a header. You got company name, retained earnings statement, and the period of time it's covering. And then you list the beginning retained earnings balance. Now, where are you going to go to get that? Remember, the beginning balance for any account is always going to be the ending balance from the period before. So what is the beginning balance for 2012 for a company? Well, it would be the ending balance from December 31st, 2011, right? So I would go to the balance sheet, I would find what was the ending balance at the end of the year in 2011, and I would use that as my starting retained earnings balance for 2012. I then add the 2012 net income, and I'm going to get that from the income statement. I'm going to subtract any dividends that were paid, and I would know that if I were working for the company, hopefully. And I would finish by double underlining the total retained earnings balance. Remember, it's always ending retained earnings is going to be beginning retained earnings plus net income minus dividends. Does that make sense? So let's make one for Hightower. If you had this information, could you produce their retained earnings statement? Remember, it should be beginning retained earnings plus net income minus dividends, and hopefully it should equal the retained earnings as listed. So let's look at it. Retained earnings at beginning of the year, $9,440 plus net income from the income statement, $4,860 minus $3,000 of dividends in that year. Do I get $11,300 for my ending retained earning balance? Yes, I do. Last but certainly not least is our statement of cash flows. Our statement of cash flows helps me understand the sources and uses of cash in the business. Now, you will notice when we get to chapter 3 that we are focusing on a kind of accounting that doesn't just count the cash. But the statement of cash flows does focus on the cash, and it focuses on the sources and uses of cash in the company's 3 main activities: operating activities, investing activities, and financing activities. And in fact, a statement of cash flows is laid out in those 3 sections. For each section, it has both the uses of cash, which helps us understand the company's ability to generate cash. It also helps us understand its credit worthiness. That's why we use this statement. Credit worthiness is essentially a measure of a company's ability to repay debt. Just like a credit card company analyzes your credit worthiness, whether or not you'll repay them when you owe them, a company is going to be analyzed in the same way. So how does this all work? So we're going to look at how all of the statements flow together. We're going to start with last year's balance sheet or last period's balance sheet. The total cash that you ended with in the previous period should be shown as the starting cash balance on your statement of cash flows. The retained earnings balance from the end of the previous period should be the beginning retained earnings on your statement of retained earnings. Then you would create your income statement. You would look at all of the company's operations over the last year. What were the total revenues, total expenses, and what was the final net income? You take that final net income and you add it to the beginning retained earnings that you had from the previous period, and you subtract the dividends and you come up with an ending retained earnings amount, which you can now use on your current period's balance sheet, so the 2011 balance sheet. You can also, with the cash that you eventually believe that you ended with from your statement of cash flows, you insert that into your starting balance sheet, and hopefully you find that your total assets equaled your total liabilities plus stockholders' equity. So if you notice, all four statements end up being attached by at least one account. It is attached to another statement by at least one account, if not more than one. This concludes our videos for your Cornerstones textbook, Chapter 1.